The Fed finally made its first rate cut in 2025. One of the main drivers of the decision was the extremely weak NFP job growth last month. But here's the real question. Is this a one-off move or the start of a whole new rate cut cycle? Powell's latest speech made it clear. The Fed is watching inflation and jobs data very closely. The next NFP report on October 3rd will be a massive deal for the markets. Before I break down the upcoming jobs report, make sure you subscribe to our channel and turn on notifications so you don't miss out on any market updates and insights. Last month's NFP gave the market jaw drops with only 22,000 new jobs added. The job growth was way below the market forecast, while the unemployment rate continued to grow to 4.3%. The same weakness occurred in wage growth. The average hourly earnings was up by only 0.3% month-on-month and 3.7% year-on-year. The report made the market more certain for a Fed rate cut in September and created a massive reaction in the market. The dollar weakened after the report and slid below the 98 level, while gold skyrocketed to a fresh record high. Three major US stock indexes were boosted by the rising rate cut hopes, while oil barely reacted and retreated from previous highs due to the prospects of an OPEC production increase. To trade around the NFP release, you've got to watch the forecast numbers. Comparing these forecasts to the actual data gives you a clear picture of where Forex, commodities, and stocks could move. For the upcoming report, the non-farm payrolls is expected to increase by 39,000 to 51,000 new jobs. The unemployment rate is projected to stop growing and remain at 4.3%, while the wage growth, though, is expected to be the same as last month, with average hourly earnings expected to rise 0.3% month-over-month and 3.7% year over year. So how could the market react to the NFP report? And what should traders watch out for as volatility kicks in? In a moment, I'll break down three key assets: the dollar index, gold, and S&P 500. So stick around for the full technical analysis. Let's start with the US dollar index. Earlier this week, DXY trimmed gains around the 97.9 level after failing to push above 98.60. The dollar stayed under pressure with political gridlock and weaker risk sentiment weighing on it. Markets are clearly waiting for the next big catalyst. If NFP comes in stronger than expected, the dollar could surge and push the index to 99 or higher. But if the job report disappoints again, we could see a drop all the way down to 97.11 or lower. Now let's talk gold. Gold is still holding strong above $3,800, hitting record highs as the US stares down the risk of a government shutdown on October 1st. Key resistance is sitting between $3,850 and $3,870. That's a psychological barrier plus the upper Bollinger Band. If gold breaks through these levels, it could easily target $3,900. A weaker than expected NFP report could weaken the dollar and push gold prices up to $3,878 or above. On the flip side, the immediate support is at $3,722. If prices break below that, it opens the door to $3,632. And if NFP comes in stronger than expected, gold price could be pressured to fall toward $3,734 or even under $3,700. And now the S&P 500 index. The US stock index is holding higher ahead of a week packed with key data and political drama. If the September NFP comes in stronger than expected, the index could push even higher, targeting 6824 or above. But if the report disappoints, we could see it slip back towards 6469 or lower. That's the full breakdown. Remember, this is just my perspective on the market and not financial advice. If you find this useful, let me know in the comments. Hit the like button, share it with someone who needs to see it. And don't forget to subscribe with notifications on so you don't miss the next market updates.